Imagine two worlds. In the first, Bitcoin is what it was created to be. A rebellious digital asset outside the traditional system. Rules unclear. Banks cautious. Institutions away. In the second, Bitcoin is fully domesticated. Regulated spot ETFs, corporations holding it on balance sheets, Wall Street building the infrastructure around it. The technology is identical. The asset is identical. What changes is how people behave. The difference between these worlds is not Bitcoin itself. It's the clarity of the rules around the asset. That's what the new Clarity Act tries to provide. But the real question for investors isn't whether the price goes up. The uncomfortable question is, how do people behave once the government puts a collar on the wolf? The Clarity Act isn't a Bitcoin law. It's Washington's attempt to bring legal order to years of crypto uncertainty. The function is simple. The SEC oversees securities. The CFTC oversees commodities. It looks like dry housekeeping, but the real lever is this. It eliminates legal ambiguity and creates a territory with clearly defined legal boundaries. Most investors believe, if this law passes, Bitcoin goes to the moon. That's incomplete. Laws don't move markets directly. They change the condition under which people decide. Governments regulate behavior. Markets respond to costs. Once legal uncertainty disappears, the biggest barrier for institutional capital disappears with it. It is the unpredictable legal risk. Once legal clarity exists, a predictable mechanism starts. People choose the path of least regulatory resistance. So capital doesn't flow into the decentralized network. It migrates toward regulated, centralized channels. Instead of millions managing their own wallets, liquidity concentrates inside a handful of institutional giants. A prime case in point is the massive accumulation of Bitcoin by corporate treasuries like Strategy and 21 Capital, where capital is channeled directly into Wall Street listed corporate wrappers rather than self-custodied wallets. Price may rise short-term, but economic activities drains from the decentralized ecosystem. Capital no longer buys freedom, it buys regulatory approval. This creates a structural liquidity trap. If institutional money may operate only inside regulated systems, liquidity splits in two. One markets become deep, liquid and government approved. The other slowly dries up. Private transactions face rising friction. Privately held Bitcoin begins trading at a discount. ETF shares appreciate, while censorship-resistant Bitcoin is starved of economic relevance. The government never has to attack Bitcoin's code. It only needs to control the gateways. Under the Clarity Act, exchanges and institutions can be required to run strict compliance and transaction screenings. You can still send Bitcoin wallet to wallet. Nothing changes technically. But the moment you convert those coins into dollars, euros, property or regulated goods, the gateway becomes the point of control. The state doesn't prohibit Bitcoin. It controls the exit. This is where Bitcoin's most fundamental monetary property collapses: fungibility. Money only works if every unit carries exactly the same value. Gateway control breaks that. Bitcoin splits into two economic classes. A coin from a regulated ETF becomes worth more than an identical coin from a private wallet. Both history is classified tainted. The protocol is unchanged, the code still works. But the market no longer treats every Bitcoin equally. The state doesn't break Bitcoin software, it breaks its fungibility. In economic terms, this mirrors Ludwig von Mises' insight into what makes money function in the first place: universal marketability and homogeneity. Money is not defined by its code, but by the fact that the market judges its units as entirely interchangeable on a subjective value scale. Once regulation forces actors to discriminate between clean and dirty units, the asset loses its uniform quality. By partitioning the supply into political categories, The state drains the network's universal liquidity and effectively destroys the token's capacity to serve as a decentralized medium of exchange. Much of the Bitcoin and crypto community celebrates Wall Street's arrival as Bitcoin's victory over the state, mistaking a rising price for the triumph of the system. That's the error. Wall Street doesn't adopt Bitcoin, it absorbs it. Yes, the price may reach extraordinary heights, but the original idea pays an enormous price. Investors gain the world's most liquid store of value, yet lose uncensorable money. They gain returns, but surrender the separation of money from the state. From a praxeological perspective, this is the ultimate irreversible trade-off. In choosing the subjective utility of short-term profit and institutional convenience, human action itself is actively trading away the ultimate tool for long-term liberty. By choosing the comfort of the cage, the market surrenders the exit.